Hello, my name is Dennis Brooks. I'm a graduate student here at the Colap School of Business at UAB. And I'm also a tutor in the Colap Tutor Lab, also in the Colap School of Business. If you need to reach us, you can contact us at colaptutorlab@uab.edu, or you can arrange for a Skype session at Colap_Tutor Lab on Skype. Today we're going to discuss Chapter 18 in AC 201. Chapter 18 is about cost behavior and cost volume profit analysis. Going to be up front with you immediately. There's not going to be an Excel spreadsheet on this because this is almost all is formulas, learning the formulas. So it's going to be definitions and formulas. The numbers aren't really going to matter because you're going to get those from whatever test. What you need to know is how to arrive at that, where to put the numbers at. So that's what we're going to work on during this session. So we're going to discuss cost, how they behave, and then what the different ratios that you will use. Now in your Chapter 18, there's several different parts that are in the chapter, but I don't know if your instructor went over them with you, such as the scattergram or high-low or other types of graphing. So I'm not going to cover those. I'm just going to really stick to definitions and concepts and the ratios and the formulas. So we're going to go ahead and get right into it. Fixed cost. Fixed cost remains unchanged in amount when the volume of activity varies from period to period within a relevant range. What that means is if your factory can produce 50,000 units and you don't go above that 50,000 units, that the cost is going to remain fixed no matter what. We're going to talk about variable cost. Variable cost changes in proportion to changes in volume of activity. For example, the direct materials cost of 1 unit of a product may have a variable cost of $2 per unit. But as more units are added, the variable cost, while remaining constant at a per unit base, increases in proportion to the number of units. So if you have 10 units, you have $20 of variable cost. If you have 100 units, you have $200 of variable cost. So it's going to increase in proportion to the cost per unit. Mixed cost includes both fixed and variable cost components. Now we're going to get into the meat and bones and start talking about the contribution margins and the different formulas that you're going to use. Contribution margin per unit is the amount by which a product's unit selling price exceeds its total variable cost per unit. So if you have a item that costs you that you sell at $100 and your variable cost in it is $70, then you have $30 of contribution margin per unit. So the way you're going to figure that out is contribution margin per unit equals sales price per unit minus total variable cost per unit. Okay? Then we're going to get to contribution margin ratio. Now this is important when you're trying to figure out what your ratio is as a percentage. So you're going to take the percentage of a unit selling price that exceeds total unit variable cost. Again, we'll use that $100 reference. You have $70 of variable cost. You have $30 of contribution margin. That would be 30% contribution margin ratio. Okay. So again, contribution margin ratio equals contribution margin per unit, which we figured out up here, divided by sales price per unit. And that gives you your contribution margin ratio. Break-even point. Big deal with a lot of companies. The sales level at which a company neither earns a profit nor incurs a loss. That's a big deal because you want to know how much money you're making or how much you're going to lose. So break even is a big concept. Break even point in units. break-even point in units equals fixed costs divided by, contribution margin per unit. Break-even point in dollars. Again, this is going by contribution margin per unit, gives you your number of units that you do it. This tells you what your contribution margin ratio has to be to get a break-even point in dollars. So your break-even point in dollars equals fixed cost divided by your contribution margin ratio. Margin of safety. Now this is another big concept. This is where the excess of expected sales over the break-even sales level means that you're actually earning a profit at this point. Now you can set what you consider to be your margin of safety. Many managers do this as part of their budgeting process. So whoops, sorry about that. We're going to scroll this up here to margin of safety. All right, margin of safety in percent is margin of safety in percent equals expected sales minus break-even sales divided by expected sales. Margin of safety in dollars. Love when this technology doesn't do what you're wanting it to do sometimes. Margin of safety in dollars equals expected sales times margin of safety in percent, which is the number we got from up here. Computing sales for a target income, also known as budgeting, is the dollar amount of sales that are desired as your target number. Dollar sales at target after tax income equals fixed cost plus target pre-tax income divided by contribution margin ratio. Now we're going to go to unit sales at target after tax income, which is fixed cost plus target pre-tax income divided by contribution margin per unit. Sensitivity analysis. When you change one of the estimates in your break-even analysis, it then affects any other estimate based off of your break-even. So we're going to go back up here to look at break-even, which we talked about, the sales level at which your company neither earns a profit nor incurs a loss. So I go back down here. Sensitivity analysis. You would first have to figure out what your revised break-even point in dollars is. So you would have your revised fixed costs divided by your revised contribution margin ratio. As an example, remember we said that out of $100, $30 of it was your contribution margin. Well, say that number changes and now it becomes some other number. Your revised break-even point number will change, and you will have to do it by what your revised fixed cost is divided by your revised contribution margin ratio. Now, up till now, we've been talking about a single unit or a single product line. Now, not many companies sell only one product line. A lot of them sell a mix of lines. So this is where we're going to talk about computing a multi-product break-even point. Working under the assumption that the sales mix of products is known and remains constant, it is possible to predict a multi-product break-even point. Now, this is a very important caveat here. You have to have these two assumptions be correct. You have to have the sales mix of products is known and that it remains constant. So we're going to talk about a contribution unit here, or a composite unit. So this company that we're talking about, for every one baseball they sell, they also sell four footballs and 2 basketballs. So one baseball at $16 each, 4 footballs at $20 each, 2 basketballs at $32 each would make the sales price for this composite unit would be $160. Variable cost would be $8 per baseball, $13 per football, $18 per basketball. This would make your variable cost for that composite unit would be $96. You then just subtract the 96 from the 160, and that will give you what your contribution margin per composite unit would be. So in this case, it's $64 each for each composite unit. And again, this operates off of the assumption that the sales mix of products is known and that it remains constant. So that means this stays the same every time they make sales. These ratios stay the same and they don't change. Or otherwise, you would have to recompute your composite unit. So we know that the contribution margin for this composite unit would be $64 each. So break even in composite units equals fixed cost divided by the contribution margin per composite unit. Now this looks an awful lot like your break-even point up here, fixed cost divided by contribution margin. Okay, it's the same concept except it's talking about a package instead of one single unit. And this is based usually off of your company's historical record, and you say these are what makes up your composite unit. And again, I can't express this enough. This is based off the assumption that your sales mix of products is known and it remains constant. So this 1, 4, and 2 do not change. Oh, sorry about that. Okay, so break-even point in composite units equals fixed cost divided by the contribution margin per composite unit. All right, there are various other subjects covered in this chapter, but I do not wish to cover material that may only serve to confuse, since they may or may not have been touched on by your instructor. I don't know if your instructor covered scattergrams or high-low. I'm going off of my experience here as a tutor, what typically are the confusing aspects in Chapter 18. And that's going to include all of these ratios. And these are what's important, is knowing what goes where rather than just the number. Because the number is going to change depending on the test or the homework assignment, but the formula doesn't change. Okay? So again, as I said down here, what I have covered in this Word document are the most commonly used formulas that students typically are tutored on. I also will not include an Excel worksheet on this chapter, as the numbers are not as important as knowing the correct formula for computing the correct answers. Okay, so Chapter 18 is really going to be just this Word document. If there's any confusion, you can contact us at colactutorlab@uab.edu, or you can arrange for a Skype session at Colac-Tutorlab on Skype. Again, my name is Dennis Brooks, and this is Chapter 18 in AC 201. Thank you.